Buying dividend stocks that are constantly increasing the amount they pay out in dividends can be a great way to kickstart the dividend snowball effect, and it can make a massive impact on your dividend income over the long term. So in this video, we're going to be looking at 7 different dividend stocks that just recently announced dividend increases. Today, I'm also happy to announce the release of a new newsletter, The Dividend Report. For a long time now, I've been frustrated by how difficult it can be to find straightforward dividend stock news, like stocks that recently increased dividend payouts, earnings reports, and also dividend stocks at a 52-week low. But this newsletter will solve that problem. This is a newsletter that is 100% free, and every week will bring you news of dividend stocks that recently increased their dividend payouts, released earnings reports, and will also give you a list of dividend stocks trading at a 52-week low. Again, there's no fluff, it's straightforward dividend stock news. So if you want straightforward news like that once a week, be sure to sign up for the newsletter at the link in the description or in the comments. Now let's jump in. One dividend growth stock that continues to deliver double-digit dividend growth every single year is Microsoft, and we can see their most recent dividend hike was about 10.7%, so that's a very nice dividend increase, and they also authorized a $60 billion stock buyback. That is a lot of share buybacks. If we jump over to Seeking Alpha, we can see over the past year, Microsoft is up close to around 34%, so the past year has been really good for them, and if we look at them year to date, currently up around 17%. If we jump over to my dividend breakdown spreadsheet, which like always, if you'd like to get access to any of my spreadsheets and also access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com. But if we come up here and plug in MSFT and hit enter, we can see all this data is going to automatically load in. And like I said, the company continues to deliver double-digit dividend growth. And the reason behind that is because their free cash flow growth has been so good. Look at the past 5 years. Free cash flow CAGR of 13%, and over the past 10 years, 9.24%. So when your dividend growth is backed by free cash flow growth, a beautiful thing happens, and that's the fact that the free cash flow payout ratio stays in a healthy range. And in fact, if free cash flow is growing faster than the dividends are growing, then the free cash flow payout ratio will actually decrease over time. So for example, we can see right now, the free cash flow payout ratio is sitting at about 33.29% as of the end of 2023. So even though this has been declining over the past few years, the dividend payouts have been rapidly increasing again due to really solid free cash flow growth. But look at this dividend growth over the past decade, going from around 97 cents per share to $2.79 at the end of 2023, and now we're sitting at $3.32. So Microsoft, again, continues to deliver on double-digit dividend growth. Let's not forget that share buyback though. If we jump over to my stock screener sheet and plug in Microsoft, the data will load in, and we can see buying back shares is nothing new for Microsoft. Over the past decade, they've gone from around 8.3 billion shares outstanding all the way down to, it looks like, around 7.4 billion. So buying back shares has been a priority for them for a while. Now let's put this 60 billion buyback into context. So Microsoft announced a $60 billion stock buyback program. How many shares can they buy back? Well, as of right now, we can see if we use the ticker data add-on, I select Microsoft and select price and hit enter, we can see the current share price at this very moment sitting at about $439. So what this means is if we take their share buyback and divide it by the current share price, it looks like if the price were to not change, which obviously it'll fluctuate a little bit, but right now they could buy back around 136.5 million shares outstanding. Now we can actually take this a small step forward by actually seeing what percent of their shares they're buying back. So again, we can use the ticker data function. We'll come over here and select Microsoft, type in shares outstanding. We'll select 2024, and then we want to select their most recent quarter, which would be Q4, and hit enter. And what we can see is as of their most recent report, they had around 7.4 billion shares outstanding. So what we can do is do equals and come over here and select the amount of shares they're going to buy back and divide it by the current shares outstanding and hit enter. And if I turn this into a percentage, we can see it looks like they're going to be buying back around 1.84% of their shares outstanding. So again, this is another nice way to reward their shareholders outside of paying dividends, because now the shares that you own are going to become more valuable. Our next stock that just announced a dividend increase is going to be Verizon. Now they have the dreaded below inflation rate dividend increase. We can see their dividend hike is 1.9%. Now, why is that a big deal? Well, you have to keep in mind, anytime a stock increases their dividend payout below the rate of inflation, they're technically paying out less in dividends. That's an important concept to understand. Now, if we jump over to Seeking Alpha, we can see the past year has actually been pretty good for this company. They're up around 30%, and year to date, up around 15.7%. But that's not been the story of the past 5 and 10 years. If we look at the past 5 years, down around 27%. The past 10 years, down 12.31%. So they're trying to turn this ship around. Now, if we look at them from a dividend perspective, again, come over here and plug in Verizon. This data will load in and we can see the starting dividend yield is actually really high for this company. It's sitting at 6.21%. So this is one of the higher yielding companies within the S&P 500. And if we look here, we can see those dividend payments have been increasing, but it's been at a very slow rate. So this low dividend growth rate is nothing new. The 10-year dividend CAGR is sitting at about 2.39% and the 5-year sitting at 2.27%. Now again, going back to free cash flow, the dividend growth is slow because the free cash flow growth has been very slow. It hasn't grown at a very healthy rate. The past 5 years, free cash flow CAGR of just 2.85%. And we can also see it's a little bit choppy. It's not very consistent. When I'm buying a stock, I want to see very predictable free cash flow growth. So the payout ratio is very high. It's sitting at 94.9%. I do favor the free cash flow payout ratio a little bit more. I think it has more value because earnings can be manipulated. But we can see the free cash flow payout ratio sitting at about 59%. Now that's not always the case for the stock. For example, we can see in 2022, the company generated about $10.4 billion in free cash flow, while dividends paid out was actually more than that at $10.8 billion, which is a very bad sign for the company. That gave them a free cash flow payout ratio of 103%. Now, if we look at the stock screener, come over here and plug in Verizon, and what we can see is the company's just really not growing a lot. Revenue per share has been very stagnant for a while now. Like I mentioned, free cash flow per share is a bit choppy and not really growing. And return on invested capital has been pretty bad for the last few years, and in fact in 2023 it was only 6%. And keep in mind, if a company's return on invested capital is not greater than their weighted average cost of capital, they're actually destroying shareholder value. So that's a big concern for Verizon. Our next stock is also a high yielder, and that is Philip Morris, and they announced a 3.8% dividend increase. And if we look at them the past year, they've also done pretty well, up around 23.36%. And if we go ahead and jump over to our dividend breakdown, we'll come up here and plug in PM. And we can see the starting dividend yield sitting at about 4.52%. Current dividend payout sitting at $5.40. And yes, they've also been increasing dividend payouts, but it's been at a relatively slow rate, probably close to the rate of inflation over the past 5 or 10 years. The 10-year dividend CAGR is sitting at about 3.36% the past 5 years, about 3.17%. So the dividend growth isn't impressive, but they do have a decent starting dividend yield. Now, this company uses the majority of their free cash flow to pay out dividends. We can see that, it's evident. Free cash flow payout ratio of 101%. Now, that's not sustainable over the long term, but we can see 2023 was the first year in the past decade that their free cash flow didn't cover their dividend payments. So we don't want to see that be the case in 2024. That'd be a pretty big concern. It's already a little bit of a red flag that it happened in 2023. But other than that, for the most part, we can see free cash flow was covering dividends. For example, in 2021, that free cash flow payout ratio was only about 67.5%, and in 2022, around 80.32%. A lot of the times, tobacco companies will be okay with having a high free cash flow payout ratio because the management team decides that the best way to reward their shareholders is in the form of dividends, but regardless, a free cash flow payout ratio of 101% will not be sustainable over the long term. That doesn't need to happen again. Our next dividend grower is a bank stock, and that is JP Morgan Chase, and this is a company I own in my personal portfolio. If we jump over to my do-it-yourself investor toolkit and blow up my growth chart, you can actually see I'm currently up 100% on this position, so it's performed really well for me so far. Now, we can see their most recent dividend hike was around 8.7%, but this doesn't actually tell the whole story. Now, why is this? Well, this was actually JP Morgan's second dividend hike of the year. If you look right here, I was talking about this on Twitter just the other day. This was their second dividend hike, so total dividend growth for the year is now closer to around 19%. So that is rapid dividend growth from a bank stock. If we look at them on Seeking Alpha, over the past year, they're up around 41.18%, and if we look at the past decade, they've done really well, close to 247%. If we go ahead and jump over to the dividend breakdown sheet and come up here and plug in JPM, we can see the starting dividend yield as of right now is sitting at about 2.38%. Now, the yield has gone down quite a bit over the past year because the share price has gone up so much. If we jump back over to Seeking Alpha and click on dividends, and look at the dividend yield history for this company, we can see there was a point in time in 2022 where it was yielding almost around 4%, and for much of 2023, the yield was close to around 3%. That was a great time to buy, and that's when I initially started adding shares of this company. If we look at the dividend history, the dividend growth has been really good over the past decade, but again, keep in mind, a lot of these bank stocks still haven't grown their dividend to where it was pre-financial crisis around 2008, but still, overall, the past 10 years have been good at about 12.35% dividend growth, and with a bank stock, you want to pay more attention to the payout ratio than the free cash flow payout ratio. The payout ratio is sitting at just 27%, so they're in pretty good shape. Our next dividend hike is one I'm pretty excited about, and that is Vici Properties, and they announced around a 4% dividend increase. In fact, it's about 4.2%. Now, why am I excited about a 4.2% dividend increase? Well, we have to remember, Vici Properties is a real estate investment trust. A lot of the times REITs will have higher starting dividend yields but very low dividend growth. But Vici's rare. They have a nice combination of a high starting dividend yield with solid dividend growth for a REIT. If we jump over to our dividend breakdown sheet and look at Vici, we can see the starting dividend yield for this REIT is sitting at 5.27%. So they make pretty nice dividend payments, and we can see the dividend growth since 2018 has actually been really good, going from around $1 to now sitting at $1.73. Now, here's where a lot of people get tripped up when talking about REITs. We have to remember, REITs are required by law to pay out 90% of their earnings in the form of dividends. So what this means is, the payout ratio is actually not the best way to look at REITs, and neither is the free cash flow payout ratio. Actually, what we want to be looking at is going to be the AFFO payout ratio, and we can see this on Seeking Alpha. If we click on dividend safety and start to scroll down, we can see the AFFO payout ratio looking forward right here at 74.75%, and for the trailing 12 months, 75.56%. So that means they're using about 75% of their adjusted funds from operations to pay out dividends, which is actually pretty decent for a REIT. So I'm pretty happy with this dividend hike, the dividend yield, and the dividend sustainability from Vici. Our next dividend hike was a massive one, and that was T-Mobile. They announced a 35.4% dividend increase and also announced a stock buyback. And if we scroll down here, we can actually see when you combine the dividends they're paying out with the stock buyback, you're looking at about $50 billion in stockholder returns. Now, the past year for T-Mobile has been really good, up around 42%. Look at them year to date, up close to 25%. And over the past 5 years, up 153%. So this company's actually been sneaky good during this time period. Now, if we look at them from a dividend perspective, we'll plug in the stock ticker. Now, when this data loads in, it all looks kind of weird, and it looks like they don't have much of a dividend history. Well, that's because they actually don't have a dividend history. They've only made a few quarterly dividend payments up to this point, so this dividend is still very new, but it looks like they're starting to prioritize it a bit more. We can see that starting yield sitting at 1.3%, and it's coming from the massive dividend hike that we just saw. So the free cash flow payout ratio for the trailing 12 months was below 10%, so this company still has massive potential to grow that dividend at a very high rate if they choose to do so moving forward. So it'll be interesting to see what management's approach is to the dividend increases. Now, if we jump over to the stock screener and look at T-Mobile, one of the things that will jump out is earnings per share skyrocketed in 2023 to the highest it had ever been for the company at about $7.02 per share, and they were also free cash flow positive for the first time in pretty much the past decade, and it jumped all the way up to $6.54. So obviously investors were excited to see these jumps, which probably led to the huge run up in share price over the past year. Now we can see there was some share dilution going on here in 2020 and 2021, and maybe a little in 2022, but they're finally starting to reduce the shares outstanding again. And then the last dividend hike I want to quickly look at is Realty Income, and this is a very popular REIT, probably the most popular because it pays out dividends every single month. But a lot of the times when they announce a dividend increase, a lot of people get upset and confused, and we can see here they increased their monthly dividend by just 0.2%, so a very small dividend hike. But what you have to understand about this company is they actually increase their dividend payments every single quarter. So we can't just pay attention to the quarterly dividends because on a year-over-year basis, the dividend growth is actually quite a bit higher. And let me show you an example. If we jump over to dividends here on Seeking Alpha and look at the dividend history, again, we can see the dividends are being paid out on a monthly basis and they're growing at much higher than just 0.2%. If we look at the dividend growth, we can see for the most part, look at the past 3-year CAGR. It's sitting at about 4.39%, 5 years, 3.5, the past 10 years, about 3.9, which is a pretty healthy dividend growth rate for this REIT because keep in mind, the starting dividend yield is pretty solid, sitting at above 5% at 5.08%. Not to mention those dividend payments do look sustainable if we jump over to dividend safety and look at the AFFO payout ratio forward looking, sitting at about 75%, just like Vici Properties. So again, a nice combination of yield, growth, and dividend safety. So there you go. There is an overview of 7 dividend stocks that just recently announced dividend increases. Again, if you want more straightforward dividend stock news, like companies that recently increased dividend payouts, earnings reports, and also dividend stocks at 52-week lows, then go ahead and sign up for free to the Dividend Report newsletter. And then like always, if you'd like to be able to download any of my spreadsheets and also get access to the Ticker Data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.